Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are glad to have you aboard today as Ben, Dan, and myself, Seth, get to talk to you about how you can make cash king. We do have quite a few things on our plate to talk about today. There's a lot of different options in investing, and one of the investment options that I'll say I never have to really sit down and explain a whole lot about is cash, right? Everybody seems to get it. That's the dollar. It's in your pocket, in your wallet, it's in your bank. Now, whether you put it in your savings account or your checking account or, under your mattress, wherever that dollar is, everybody gets it. And there's also a whole lot that can be learned about how to use this as a tool for investing. And so, the question we have today is cash king, right? Or how can you make cash king in your retirement story? And it's, believe it or not, it is going to unfold into a tremendous asset that we can't wait to jump in with you today as we roll into Money in the News. Mr. Elon Musk offered a Florida teen $5,000 to delete a Twitter account tracking his jet, and it wasn't enough. Thank you, Ramesha Maruf from CNN Business, for bringing us this important headline. It's a lot of fun to see what Elon is up to these days, but
clearly the guy's got 150,000 followers.
Gosh, yeah,
that's a lot of followers to know.
All tracking his jet.
All tracking his jet, right? I guess if I was Elon, I might just fly my jet somewhere without me on it.
Yeah, he actually found this guy on Twitter and actually asked him, through the app, can you take this down? It's a security risk. And he was concerned about, some nut job tracking him down, following him around the country and, taking a pot shot at him. But it sounded a little silly when I first read it, but, truth be told, that might actually be a risk for him.
Yeah, no, I really do. I mean, I really like Elon. But, you think about it, there's people that don't like all sorts of people in all sorts of situations. So some psycho wants to pick him off. I mean, technology this guy built, which is really very interesting. It's nice to know that you could build something and get the attention of Elon Musk.
In fact, this is part of this negotiation with him. He asked him for an internship. He turned down the $5,000. We went up to $50,000. Elon balked at that, but he said he'd trade it for an internship in the end.
Absolutely. Would you want the opportunity versus the cash in hand? Or
well, this college freshman developed this program, and he's also tracking Bill Gates and Jeff Bezos, and he's tracking them all.
Probably some of our listeners today. You just don't even realize it.
You're getting tracked on your jet.
Your private jets are now
Private
tracked.
jet problems.
Yeah. When you have a private jet, these are the problems you face. I guess you just don't know what you're walking into when you get a private jet.
Gosh,
I hope to someday have those worries.
Yeah, I wonder if
I don't.
We should be able to package some insurance and sell that somehow, right?
In fact, in the end, this kid actually he gave Elon the way to block his own account so that it wouldn't be tracked. So there's a little bit of morals in here too. He didn't get the negotiation he wanted, but he did give him the solve if he was truly concerned.
At that point in time, I would have given the kid the internship.
He probably got it. Who knows?
Yeah.
Good stuff. Did you realize drug makers and drug manufacturers are keeping up with inflation? Maybe
that's
just
something
barely.
I'm not worried about.
You weren't?
I was not worried about that when I read this article.
No, not at all. Drug makers raised prices by 6.6% on average a year. That was one of the things around the Trump presidency that I really remember him kind of being a hardline about, is really trying to reduce some of the costs in drug manufacturers. And eventually that may not have worked out well for him when it came to who was backing him in the later phase of his presidency. But those 2015 and 16 years were significant in drug manufacturers raising their prices and really making it really hard, I think, for a lot of people that were in need of some of these life-saving drugs to be able to afford. So, putting a little bit of a hedge here on this is just some interesting news for us to take a look at.
Yeah, if you look at some of the different companies, they're all kind of seem to be raising right in line with that. Looked at Pfizer, their average cost went up 5.5%. Novartis AG, average up by 5.7%.
This is my skepticism coming out full bore here. The government's trying to help curtail the increased cost of drugs. I get it. I appreciate it. Right? Do you think healthcare is a privilege or a right? There's that whole debate, the whole conversation around it. And the drug makers on one level are like, we're going to play ball. We're going to minimize the amount of rate increases that we're going to have. We're going to do this and we're going to do that, which only stalls the government longer from making some sort of real movement, right? So they get another year or two, and they raise it. But I think what's really funny is that in the correspondence of this entire process, right, most of these drug makers that we're talking about, the 150 drug makers, like a big majority of them just got all of these shots purchased by them worldwide by the government, which causes inflation, which is the significant reason for inflation is the amount of debt we've chosen to do to pay for these shots for everybody. So, I mean, they're still getting the money. Like we're paying for it in inflation. So instead of thinking about inflation being up the 6-7% that it's talking about in this article, I think it's interesting because if you take that plus the inflation plus the inflated cost of healthcare, we're looking at like a 7% cost. I mean, a 14%. I mean, I don't think we really put in perspective that our inflation is highly driven by the amount of debt we write. And we've written a ton of debt, 10 trillion over the last X number of years and throughout this entire COVID craziness. And most of that money, a good chunk of that money is going to these healthcare providers, these prescription providers. If you're Congress, right, and you're looking at it and be like, listen, let's look at your revenue flow for the last 2 years. And let's talk about how much money you've gotten from our government. Well, now we can talk about increased costs maybe should be more like 1% because we've made you extremely profitable.
Good point. Yeah. Let's pull back some layers and take a look and see what the reality is of where those dollars come from. And if the government is working behind the scenes here, shouldn't there be a little bit different transparency on the other side of the transaction is what you're saying?
Yeah. How many trillions of dollars? Did we spend $1 trillion on shots and the development of the shots and the funding of the research and the actual purchase of the shots, like the manufacture? Like none of that went to anybody's U.S. pocket directly, right? You can walk into any Walmart, Walgreens and say, I want to shoot me up. Matter of fact, do it the next 3 times, right? When the 4th booster comes, which we're probably going to hear about here shortly, right? They're going to pay for that too. We've paid for the entire road, and then they're just going to continue increasing the cost on everything else. For me, I believe healthcare is a privilege. That's just a privilege. It's something you choose to pay for. That's where I come from. That's my background of I'm speaking from. But at the same time, like we're already paying for all this stuff, and these companies then mark all this stuff up. And if the argument is that it's a right, then the right should be that we've already funded your company to be more than financially stable. We think you should take a little bit of a hiatus on the increase in pricing. Or, if we're going to pay for you to be in existence and all your research and all your work, it seems like they're getting on both sides.
Yeah. Yeah, I can see that perspective. And it's, at what point is there cost controls and those levers in place if you are receiving assistance?
Yeah.
Is there anything to say that they shouldn't?
Well, it's like I'm coming from one perspective that's like, hey, listen, I believe in capitalism, and I believe that these people should be able to make money. I don't have a problem with that. That's totally fine.
Right. But you've gone over to the other side here and said we're going to go ahead and receive basically all of the benefit that the government's willing to give us, which is not necessarily a capitalistic type of activity behind the scenes there.
Exactly.
It's very much the opposite.
Yeah, exactly. It's exactly opposite there, but then they're taking the capitalistic approach here. They're getting it on both sides, and I'm thinking to myself, you either come from one domain or the other, and you're either saying, hey, listen, the government's going to fund these companies, they're going to pay for everything, well, then they should be able to curtail and shove the price increases on. I mean, the increases on diabetes and cancer drugs and all these things, and guess what? Some of the major offshoots of these shots, diabetes and cancer, like these are like major issues. I mean, these numbers are growing rapidly. And so guess what? They just increased everything by 6.6% on average.
Interesting number that they have there. Hey, speaking of numbers, we have U.S. wages. Benefits rose at a 2-decade high as inflation picked up. So not quite the 6.6% that the drug manufacturers increased theirs at, but 4% is what employers spent on wages and benefits last year as workers received larger pay raises in a tight labor market, rebounding economy, and a period of accelerating inflation, making it the largest increase not seen since 2001. By the way, thank you, Gabrielle Rubin.
Well, the thing about this is really interesting because we've been hiring for a while. I mean, we have multiple positions open. We're not alone in this world on that scenario, right?
It's one of the reasons I'm here today is because I appreciate that. Thank you very much.
So, but the thing is, and I've mentioned this before on this show, that, and this is one quote from the article. Investors and the Federal Reserve policymakers now consider the labor market to be at or near full employment, despite the fact that the economy has only recovered about 84% of the jobs it had before the pandemic.
How does that work?
Well, I mean, every time someone turns 65 years old, they're no longer considered like an eligible employee.
Oh, so we're aging this huge part of the population over the 65 years old, and that's so we haven't quite caught. Okay, I see.
You're doing 10 and 20,000 people a day go 65 or older, right? So, well, you're either going 65 or not, right? But there's constantly people retiring every day at massive quantities, and we've talked about the aging America and how the investment strategies are specific to that, but we know for the next 20 years, like 80 million people are going to retire. Now, for people who don't understand how dramatic that number is, we only have 320 million Americans in this country. That's huge. Our workforce is retiring.
Yeah, it's incredible that kind of downsizing of the job pool that they built into these numbers, and certainly that aging and retiring has got a lot to do with it, but it can't be all. I mean, 16% of the workforce didn't turn 65 in the last year, so.
Or they died.
Really, well, I guess there's some combination of events, but it just feels like there's some kind of cooked-in downsizing of the market that's just built into these numbers.
I think you're just underestimating the amount of people retiring. I mean, you think about 20,000 people a day turn 65.
That's a big number.
That's a big number. A day. That's crazy. I don't know if it's like 18 and change or whatever, but that's the rounded number that they use. And that's a lot of people.
It certainly is.
I think the thing is that, from an investment standpoint, you really need to understand that this is going to be an ongoing problem for a very, very long time. I actually listened to an economist. I can't remember her name. I've heard her a number of times at different conferences I've gone to. She's been on CNBC and a number of different places. I'm just blanking, but it's coming to my head now. But she had done and you guys know this about me. I'm a shut the borders down. Like, people come through by whatever laws we have put in place, and I'm all for it. But what her point was, it was interesting to me because I had never processed it. This is going back 10 years ago. She said we will have such a lack of people in 20 or 30 years to do the jobs, we will be begging people to come to America. I thought that was an interesting point. She's like, we will be asking people to move here just to do the work.
Yeah, it seems like that's something we're already experiencing on kind of the bottom end of the job market, but I feel like that's been a trending and growing issue for a long time. So it could only continue, right?
Right.
Well, I think that's going to do it for us in Money in the News. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, we're talking about how do you make cash king in your investment strategy. Don't go anywhere. We'll be right back.
folks, we have a lot of fun doing this show, Money on Tap, and Ben and I have been financial planners for years and years, and our goal here with you is to bring you into the room, have the conversations that we have. We think these are critical conversations for you, but we understand this is a limited space. And what we'd love to do is to open the doors to you with us at Brayshaw Financial Group so you could experience what it means to have three-dimensional planning in your life. Let's take a look at all sides of your situation, your scenario, and see how we can put together the best plan possible, taking into account your risk. How much can you have in the market? How much do we need to have set aside and doing different things for your life? That's what we do as planners, how we engage with you, and we welcome you to do that with us. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Now, if you have $250,000 that are investable assets today, our planning is free to you. We want you to have the playbook to have a successful experience in retirement. Give us a call, 855-226-8551 or info@yourmoneyontap.com. Ben and I welcome you to Brayshaw Financial for complete wealth management.
Now back to Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And today, folks, we get to talk about how you can make Cash King, or how do you make Cash King? It's the probably the most liquid, easily accessible of the investment options that are out there, and one that pretty much everybody's familiar with. We don't have to usually sit down and have a very large conversation like we're going to have today about cash, but it's significant and it's important for you to understand, hey, what is this and how does it work in your investing? One of the things that I think is really interesting is just it is the relationship that almost everybody has with, their own finances, and whether they're savers or spenders or whatever they're doing. We come across so many different scenarios just with people in their day-to-day around cash. It's a good topic for us to address.
Yeah, I was going to say a lot of people are just wondering, like, goodness gracious, a cash show. This might be the most valuable show you ever listened to. I mean, I mean, people really. It all starts with fundamentals in everything you do. Like, you coach soccer, you work on fundamentals. You basketball, you continue to practice your dribbling. Like, what pro athlete haven't you ever seen step on a court and just start dribbling the ball immediately? They're constantly working on fundamentals. Cash is a fundamental concept that we all start with. And, I think about my 14-year-old son who got his first job. He's all excited. He's working here locally at Pat's Peak, and, he's making money. We opened up a checking account and we opened up a savings account. And, I've discovered that, every child I have, their personality around money is all very unique, and it's ingrained. It's like a biological thing. It's very, very interesting. I mean, I know that about clients, but you think it really develops, right, as they just kind of age in life. But in reality, it comes from this kind of inner feeling, this inner understanding of how your security and your well-being are. And I think there's a lot to be said around that.
I think it's the thing that we're all closest to, right? It's the one that you use every day, you consider every day. We'll meet with people that, they couldn't tell you what their net worth is. They have no idea what's in their 401k. They got no clue what their house is worth, but they could tell you what they got in their pocket for sure, or what's in their checking account, right?
To the
most
dollar.
Immediate,
Yeah.
It's the most immediate everyday thing. So it's what people are most aware of. And there are just different ways to be more efficient with it, and that's what we'll talk about.
Yeah.
Yeah, I was also going to just jump in on that. It's also what gives us a lot of opportunities too when life presents or investment opportunities become available. Having a way to convert in or out, it also gives us that window too.
As we get into today, I think we're gonna talk a lot about different ways to invest and to invest cash. and how to have access and liquidity. We're going to go through all those different points here today. I think the first thing is really kind of understanding where cash should be, because there's a lot of people I meet that have huge amounts of cash. They become hoarders of cash. They become hoarders of assets, and they don't make it functionally work for them. And then there's another distinct group of people who just don't have any cash. They're completely cash poor. I find it one of these things that's very unbalanced. It's like the teeter-totter's either all the way on one side or all the way on the other. And as we're trying to figure out, one of the words that came to mind for me was just the idea of monetizing liquidity. What does it mean to have liquid money? Like, what should it be? Where should I, how much cash should I have in my checking account immediately to write a check at any given moment, to present it to somebody who can run it through a system and boom, it's paid for? What is that number? And then what's the savings account number? How much money do I need to have in my savings account? Do I need a savings account? Like, these are all questions that I'm really interested in to kind of talk through with you guys, and because we all have different clients and we all give different advice from our own backgrounds, and that's who we are. But when I first start out with clients, I really do evaluate cash, because cash is an emotional asset. Like, I meet a lot of people who have cash, and they might have $100,000 or $500,000 in cash sitting in the bank, and it's invariably one of the reasons why people come to us. I don't know what to do with all this money. You might be a listener today saying, I'm not that guy. That's okay. It's still the same conversation. You have money. You're listening to the show because you're thinking about investing. You're thinking about, how do I move forward, right? Whether it's $5,000 or $500,000 or $5 million. And the thing I always talk to people about is that there's obviously your monthly bills. Like, you should have on hand in any given time at least a monthly amount of cash sitting in your checking account at all times. Now, that varies all over the place for somebody who's, maybe on commission versus salary. Like, if you're getting a paycheck every week, that's great. Boom, you know exactly how much goes in, and you can measure that. And then you start really building from there. And, that's kind of how I start. But for people who are retired, and I meet people who might have $100,000 in cash, and be like, well, what's your biggest, largest feared expense that you might have coming up? What's the one thing in your head that says, I need to have this much cash? Invariably, it's a healthcare issue. Like, hey, what happens if I go into the hospital or this? So what are you not covered for? What is Medicare not going to cover for the next 100 days that you would have at 65 or older? Right? Because if Medicare is going to cover everything pretty much for the next 100 days roughly, then you have a 100-day window. Maybe you want to bring it down to 60 or 90, but you have a 100-day window to acquire money out of other assets to build cash. So those are things that I kind of chat about with people.
Yeah, I think kind of the point you began with is, kind of the first line of defense, right? So what do you need in your checking account? And I think a month's worth of expenses is a reasonable number. And then you tear it up to the savings account. And so how much money do you have to have in there? And, we've been through different programs and trainings, and the 6-month number comes up there a lot, right? You want to have 6 months worth of expenses and savings. And then after that, do you hold other cash equivalent or cash assets? Do you go right into the market with whatever is above and beyond that? And these are the decisions that we could talk about here today. And I think that's where that conversation around the value of liquidity comes back into play, right? So you're going to do something with that excess money, right? So you've got 1 month in checking, 6 in savings. Where does the rest of it go? And a lot of the answer to that question will have to do with, well, how fast might you need it, and how much are we talking about?
And the question is if you could find something that, was as liquid as savings, that provided a better rate of return, and it just didn't have that, and, it was called Acme whatever as a joke, I mean, like, it doesn't really matter what the name of the asset is or what the investment is, as long as it's just as liquid, right? And so, I think those are the things that people are wondering, because every piece of cash you hold back, you look at inflation at 5-6%, and you're making whatever you're making at the bank, if you're making anything, when I was a kid, we had interest rates on checking accounts.
Right.
So,
yeah, that's one thing for sure that we know is that none of these cash equivalents will pace with the current inflation scenario. So we got to hope for that to taper off a little bit, and then some of these opportunities will start making more sense, short term and long term. But inflation right now is certainly an issue against what you can get in these cash type investments.
Yeah, so basically the inflation question is what is inflation at? And that is roughly 6-7% is what the recent numbers are. That was under 3%, but that target that the Fed has had is around 2-3% of the past. In recent history, it's been very, very low, and but now it's risen. But that's the headwind against your cash. So that's going backwards in your holding every time that you look at that checking account, and let's say it was $100,000. Well, guess what? Next month, it's actually worth a little less, even though it might say $100,000, just because of the way that when inflation works, if all the cost of goods and services. So if you have some way to stay like nimble or liquid, like that cash is, and still be earning something on it, would that be better? Right? Probably. I think we all would agree. Yeah, earning something on our money is better. But the question that most people have in the investment world is like, what is the consideration there? Like, am I giving up liquidity? Do I have to wait 3 days before that becomes something that's available to me to be readily available? Or is there, fluctuation? Is it something that has an up and a down in it? And so what are the different places where we might say that this is still considered cash? But it has some other return hopefully that would be significant for us to say, you know what, we're willing to go ahead and maybe give up a little bit of this flexibility that we have right now in this cash holding. So for starters, have you guys ever heard of a CD?
I have.
You have?
I have, Seth.
Yeah. Okay. Well, that wasn't for you necessarily, Ben, but I'm glad that you have. And Dan, I assume that you're in the room here today, that you're a part of the...
I'm aware.
Okay.
Certainly aware.
Okay. Well, certificate of deposit is what a CD stands for, folks. And it is something that if you've ever been to the bank and you've had anywhere around, I don't know, 5, 10, 20, whatever the thousands of dollars are that you keep in your bank, they probably have kind of pulled you aside. Well, I'm trying to think, like current day, nobody's actually at a teller. So they used to be tellers, right? And they would kind of pull you aside and be like, hey, have you thought about this CD over here? Oh, what a novel idea this thing is. It has a certificate of deposit. It has a guaranteed return on it. And it's FDIC insured, right? Some pretty cool things that go along with it. And CDs used to actually have a pretty a fair return, I'd say, is what I'd call that. You used to be able to leave it with the bank for 6 months, kind of that average coupon there, or that time period that they'd try to attract your money to hold on to it for. And for that 6 months, maybe they give you 3% return in that 6 months. But the thing of it is that you just couldn't, you could get it, but you would forego that interest on it. But you would kind of lock that cash up for that period of time. And you'd be okay with that because it's, it's at the bank, it's insured, and you're going to get your money. So that's how the CD piece works. And they could extend these periods out for, 1 year, 5 years, whatever, generally not more than that period of time, right? Usually it's like 1, 2, 3 years or something like that at the longest. But the longer that you give the bank your money in the CD, the higher that your investment return should be on that. So pretty simple way to say, what's one of the options that I could have here for this cash?
I think, what's funny about CDs is, and I had, I'm not a banking expert by any means, but I thought it was interesting. I was listening to someone speak about the CD rates. Like, why is one bank offering a CD rate? So CD rates, the comparable, and a lot of people use checking, then they use savings, and they kind of move to CDs, and then then they start saying, we should probably sit down with somebody and talk to somebody about some more structured investing, kind of thing. But the CD rates, for the 1 year were between 0.2 and 0.65%. You're just talking, Seth, about like a 3% CD. That's just a...
Well, you remember those days.
Yeah, fondly. I look at those. And, a 3-year CD, you might be looking at between 0.2 and 1%. Why is one bank offering a 0.2 versus a 1% yield? And I thought it was interesting because a lot of people don't know that the overnight deposit rate ratios are why banks offer these rate variables. They basically, if they're overnight deposit ratios are off, and they have to have a certain amount of money on deposit based on what they're lending. And when they go over that, they have to borrow money overnight to cover their ratios. And so what they'll do is it's cheaper to offer a little bit better CD rate than it is to do that. So they might actually lose money on CDs just to save money on their deposit ratios.
But it's all about getting money in the door.
Exactly. Yeah. And the thing is I thought it was interesting that someone said that when somebody has really, really high CD rates, it's actually a time to be fearful of that bank.
Oh, boy.
Because if they don't have – I mean, the government can come in and shut them down if they can't meet their numbers. And then you have to go and get your money. And that's where the FDIC insurance becomes really a big player. So if you're working with a bank – now, it's not always the case, right? But if you're working with a bank that's offering an exceptionally high teaser CD rate, you should be buyer beware. I thought that was an interesting perspective, and I hadn't really thought about the vulnerability or how you don't know how vulnerable a bank is by offering those really high rates.
You wouldn't think that, really. I mean, how long has it been since you've had a run on the bank, so to speak?
Or who knows if we're going to have one? You know, I mean, back in the 80s, it was horrendous. Now, not such a big deal. You know, I think what a lot of people, you know, they use these kind of first three mechanisms as their kind of cash alternatives.
So first three would be the checking account, the savings account, and the CD, the certificate of deposit, right?
Yeah, and that's kind of standard. And I would tell everyone who's listening today, that should not be your standard. We're going to kind of go through this. I'm really kind of excited about this because this is stuff that we do with people every day as we move forward on trying to understand cash and how to manage cash and how to understand cash. So as we're going through this, and we're going to take a quick break here, but we're going to start talking about some alternative investment strategies and how to layer your cash to make it work more for you.
Folks, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Today we are talking about how you can make cash king, and I cannot wait to get into this discussion with you guys. We'll be right back.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
Now back to Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Today, folks, we get to talk about cash. Is cash king, or how do you make cash king in your portfolio? Just spend a little bit of time kind of just chatting about, savings accounts and interest that's earned on those and inflation and how that works and CDs. And those are kind of the common places where most everybody, revolves around a bank, right? But there's so many other options out here in the cash world or this liquid investment arena. And most of those options have some kind of like a fixed return on them. If we take a look at like why even consider these a cash option, right? And then the other side of that is what's the consideration? Sometimes there's a period of time that we're willing to let go of that cash to be able to kind of back ourselves into this, how I feel comfortable with what I've got on hand if there's, the emergency situation or, Ben was talking about a medical situation and really that having that cash on hand to try to help support that idea so that we feel much more confident in and around our finances. So we're going to go ahead and start talking about some of these other options that are out there. And ultimately, we want to talk about some of the strategies involved here that we take a look on a daily basis to really help give you the best option possible to how to manage your cash?
So, I think one of the things is for people who have a lot of cash, we should probably be your first phone call. I think there's a lot of people who have cash and they're balancing between bank after bank after bank because of FDIC insurance.
Right.
We meet people all the time. They have businesses. They've got, 10 different banks. They got $250,000 under their name, the business name. Like they've done all sorts of different things to mitigate, the fear of a bank going under. We talked about that earlier. One of the things that our brokerage accounts offer is excessive FDIC insurance. So $250,000 is an individual's FDIC insurance at a local bank, right? And so you'd have to go to 10 banks to have $2.5 million of FDIC insurance. In our brokerage house, Pershing, which is backed by the Bank of New York Mellon, we have FDIC insurance on our brokerage accounts that actually goes up to $2.5 million per person without having to go to 10 banks.
Per entity, as a matter of fact.
And per entity, yeah. And so that creates a huge opportunity for managing cash. So if just managing cash because you have to have cash for whatever reason that is, we should be your phone call like as soon as you pull over, as soon as, if you're listening to this and it's, Sunday afternoon, call us Monday morning because we are the solution for that. People use us for that stuff all the time. And that's where we kind of help people start branching out in how to mitigate timing that cash, right? We talked about, the 1 month having that on hand in the checking. And then some people think 3 months or 6 months, right, Dan, of having savings on hand is like kind of that tool. The truth is what people find is that they keep adding to that 6 month or whatever, and then all of a sudden they got 9 months, and then they got a year, and they're proud of that, and that's great. And I compliment you for being that disciplined because that is discipline to do that. What I think people lose focus on is if that's $50,000 or $100,000, and that sits in a bank for 30 years until you retire, what a waste. Right? And so as we move forward here, we want to talk about a couple different things. We want to talk about, we're going to talk about T-bills, which probably nobody cares about. We're going to talk about short-term bonds and short-term bond funds. We're going to talk about money markets. We're going to talk about the 10-year note. We're going to talk about a lot of stuff. We're even going to get into fixed annuities that look and smell like CDs. As we first jump in, we talked about CD rates. So let's talk about perspective, right? So, Dan, the top end CD for a 3-year was 1%. I thought it was interesting that, a fixed annuity, which is, guaranteed just like a CD. Now, its liquidity, depending on your age, could vary. So you have to understand the disparity. Like if you're over 59 and a half, its liquidity is irrelevant. But if you're under 59 and a half, the annuity is not liquid. So that's kind of something that comes into play. But with the low end of a CD being 0.2% and the low end of an annuity for 3 years being 1.45%, that's a significant difference. I mean, astronomically different.
Yeah, and that's kind of always the way as you kind of track the comparative durations, right, between a CD and an annuity. You're always going to find that there's significantly more interest to be had in the annuity. Now, there's trade-offs for that, though. We kind of started hitting on that. One of them's the age 59 and a half. Of course, that's a significant concern. And then one of the other ones, the primary other one, would be liquidity. It's been long assumed, and there's some reasons that make sense, that a CD is more liquid than a guaranteed annuity may be. But one thing I like to kind of counsel people around, the question of which is more liquid has everything to do with, well, how much of the value will you need and how often might you need it? Because inside of the CD...
Which is totally the argument we're having here, right?
Yeah.
Like how much cash do you have to have?
If you need all of it, yeah, then the CD is going to be more liquid. But generally speaking, people don't find themselves in that circumstance. And if they did, it would be some other asset they're looking to raise cash, right? So the way it works is that inside of a CD, generally speaking, all right, at the end of the term, whatever it is that you purchased into, you're going to have a window. A 10-day window is very common where you can either cash out, or if you don't notify the bank of anything at all, they're going to renew you into another term of whatever the initial one was. If it was a 1-year CD, your 10-day window comes, you haven't notified them of any decision, they're going to roll you automatically into whatever another 1-year CD is paying presently. And if you miss those 10 days and you want any liquidity at all, you're going to pay an interest on the penalty on the interest that you've earned.
Which is usually like a quarter or a half a year worth of interest.
Yeah, when you're making very little interest, the penalty is going to absorb all of it or a lion's share of it pretty quickly.
I mean, on 365 days, folks, 10-day window to grab all your money without penalty from a CD. To grab all your money. I mean, that's, to me, is just
Does that
something
seem fair.
Well,
It's not liquid. That's what it's not.
It's just not. And I think that's the fool's perspective is that, and it's I say that, I don't mean that in a negative way. I'm just kind of, the concept that the banks have communicated to us that CDs are liquid is just really the biggest falsehood, honestly. I mean, we can buy and sell CDs. Like, we have tradable CDs that we can actually do business in. And some of those actually perform just as well as a bank one, and you don't have to deal with some of the losses. It's just not what we do every day because it's not really relevant. There's other vehicles when people come to us that we can solve that problem with.
Yeah, and then kind of the flip side of that coin is the annuity story, right? And there's other options we'll get into as well. But just to kind of round up where we began, the annuity is going to pay you 3, 4, 5 times the interest, whatever it is, depending upon the bank it's provided through and the term you choose. But the annuity is going to have, typically speaking, and this varies a little bit, but anywhere from 5 to 10% of the value of the annuity is available to you as a free withdrawal, one time per year, anytime you want, all 365 days. So if the liquidity in your mind is, well, I might need to access some of this cash versus all of the cash, then you might as well go for the better rate, right?
Yeah. And I think the thing is funny, Seth, you were joking around about CDs that used to pay 3%. I mean, and you could, hey, listen, I would love to have a CD that pays 3%, but, a 5-year fixed annuity on the top end here from A-rated carriers are paying 3%. Mm-hmm. It's compounded. It's tax deferred that CDs aren't. That's a huge opportunity for somebody who's just kind of now. We were off air during the break. We were talking about how all these rates take you negative against inflation, but it's better being less negative than being 100% of the negativity here, right? I mean, with if you're at a 3% interest rate on a fixed annuity for 4 years, 5 years, and so forth, you get a lot of opportunity to just kind of like sit back. And if you're over 60, it's liquid. 3 years from now, it's 100% liquid. If you're willing to buy a 3-year CD, you basically have those 2 10-day windows in between your 3rd year anniversary to get 100% of your money out. So you sacrifice that. Okay, you've sacrificed that one window of opportunity to have a 10% opportunity each of those years of what you put in there. What does that mean to you? Right? There's fees to get out of an annuity early, just like there is for,
sure.
For that. You're going to pay a surrender charge and so forth. So if you really didn't need 100%, it could happen, but you're going to be something subpar of that, right? You're going to have interest associated with that. So that's one thing. Then I kind of get into the short-term bond world. That's the next kind of in between. Like, let's say you're not over 60 and you're starting to say to yourself, CDs are really not my play, but what do short-term bonds look like for me?
Yeah, I mean, I think that's an opportunity to consider, based upon where rates are at. It's certainly a little bit better than the CD world, and it'll offer you some more liquidity in that you can get in and out of that fund or bond fund or short-term bond, readily, basically at any point because it's a tradable asset. But when you look at the yield on something like that, and we looked at a couple of averages coming in about 1.5, minus the cost of holding a fund like that, they all have internal costs. Your net yield on something like that is going to be about the 1.4% neighborhood.
Right. Now, Seth and I were talking about the idea of short-term bonds versus short-term bond funds, and I think it's important to say that there's a significant difference here. Short-term bond funds, they are a group of short-term bonds. So you buy a bond fund like you'd buy a mutual fund, and they own lots of different bonds, and they're trading them and so forth. And they have, the idea is that everything's going to be a short duration, so there's less, vulnerability to this. But Seth, you were mentioning that, you look back historically on the short-term bond funds, and they're all negative for their years, right?
Yeah, basically trading flat. I mean, and that's even taking the yield into consideration. And if you look at any one of these charts on a bond fund, they're going to trade up, they're going to trade down. And, really there's a question there. If you're looking to get into a bond fund, how vulnerable are you to the market? Because you're going to have that fluctuation that happens inside of the market as well. You know what? There's one of the things that you're talking about was the opportunity, Ben, is with your cash, right? What is that cash? What is the intention? What is the purpose around your cash? Is it that peace of mind that you need to have something there that you're like your operating expenses to make sure that you're covered? Great. That works. Is there a 6-month window that if something happens, you really need to make sure that you've got things put into place so that you have access to it? Well, understanding that, that's good. But also, there's the opportunity for other things to be happening with your money as well. And I'm just reminded as we were talking about opportunity is the Matthew 25, 14 through 30. It's the parable of the talents where, there's the master that goes away and leaves this basically his property with the servants, and each one of these servants does something different with it. And it's the one that just buries it in the ground and does nothing out of fear that is judged more harshly. And I take a look at that and I'm like, wow, how does this apply to each and every one of us? Is that where we're at with our cash and what we're doing presently? Or are we being strategic about looking at the opportunities in front of us and putting things in place and putting things in perspective so that we're doing the best we can with the opportunity we have been given?
Yeah, and I think that's the whole point here, is trying to amplify and help people who are in fear of not knowing what they don't know, right? They don't know how to invest. They've been told to save. I'm saving. Okay, I'll buy a CD. That sounds like I'm not burying it in the sand concept and so forth. And I think as we kind of move into these different avenues, and I know we have a break here to take. I just want to make the one point on the short-term bond piece as we kind of dig through this, because the short-term bonds and the short-term bond funds are really important, because short-term bond funds can lose money.
Right.
Like, I mean, you can, there are people trading bonds constantly in the background, and, interest rates.
Market driven.
Right. And those interest rates keep going up. Yeah. Right. We hear about the Fed. So if you're, listening to any market news, you hear the Fed's raising rates. When they raise rates, I guess my phone's going off. So they raise rates, and then all of a sudden, new bonds are offered with higher rates. That sends old bonds down in value. That's a big problem. That makes older bonds worth less. Now, if you buy your own bond, you buy you call us, you say, hey, Ben, I want to buy a bond, best rate I can possibly have for the next 6 months or year. You can hold that bond to maturity. No one's going to sell it out from underneath you. You can hold it to the day that company has to pay you, and they'll pay you your money back. And you will collect that interest the entire time. That's the power of owning a bond. Now, if a new bond's offered, you can say, well, you know what? I missed out on that opportunity, but I'm going to collect my rate as I collect it, and I'll get my money back. That's a legitimate way. And I like that methodology today, kind of like buying a CD and saying, well, you know what? I know they got new rates out there for CDs, but this is the CD I'm in. Buying a bond and saying, this is the bond I'm in, and I'm going to hold that to maturity and collect the rate I agreed to. I think that's a better scenario than just kind of putting your tailwind in the market and just saying, I'll let somebody else go trade all these bonds. Well, you can just go buy a physical bond yourself.
Good point. If you're listening to Money on Tap, you can reach us at 855-226-8551 or info@yourmoneyontap.com. So we've been spending quite a bit of time talking about cash alternatives. How do you make cash king in your investment strategies? And getting past that, first layer, right, that checking the savings, one of the things that needs to be accounted for is that opportunity, and starting to build in some of these other layers where, yes, you have the access, and yes, it is liquid, but you're starting to look at some greater duration, and ultimately you're wanting to start to take a look at a higher return for that consideration. And, Dan, you were talking about, the annuity piece and how, taking a look at the annuity world, it's not a static, like one-stop shop, right? There's like so many different offerings out there. Could you talk a little about kind of maybe some of these layering in the investments in these annuities and how that strategy looks or works like?
Yeah, I mean, one of the things that's interesting if you watch the interest rate world and all the different instruments that are included in that, from bonds all the way to annuities, is that sometimes you don't get paid anymore for your time, right? That there's just a capped out rate regardless of duration. That's the best you're going to do. And the example I'm pointing to here is, looking at today's current and best rates, which we did in preparation for the show, you literally don't do any better between a 5-year annuity with a 3% multi-year guarantee and a 10-year annuity, which also is topping out around 3%. And in between, it's odd, but like a 7-year offering goes up to 3.1%, which led the way. But for my money and the advice you'd receive from here, why go 10 years when you get the same rate on something for 5?
Well, I mean, that's relevant. But then if you go back to like the 80s when people were buying 15% CDs for 5 years, I'm sure they wish they had locked that in for 10,
Right.
So like, hey, 5 years from now, your reinvestment risk might be only a 2%, but it could be a 6%, right?
Yeah,
you don't know where the rates are going.
Just given what the Fed has to say about raising rates, you would think that chances are you'd be better off.
Right. Yeah, and there's some conversation around whether or not the Fed has peaked out at different times. I remember, I don't know if you saw that on CNBC. They were talking about how they had raised rate, and all of a sudden it started to crack the economy a little bit, and then they had to pull back their rates again. So there's some conversation around all that. I think is a little
you mean
scary.
The Fed changed their mind about something?
I don't know.
Never.
I don't know. Well, anyways, so as we're talking about this, I think the best way to think about this is in buckets. I think that's what, Seth, you were alluding to a little bit, is like the idea that, you have your checking, you have your savings, and then you all of a sudden you have maybe your money market fund with us because you're looking for some FDIC insurance, but you don't want to deal with 10 banks, right? But then you say, hey, Ben, inside that money market, because it's a brokerage account, let's buy some dividend stocks. We've talked about our dividend stocks in our last show and trying to maximize yield there. Or maybe we buy a bond in that portfolio. We can literally start adding little by little smaller increments to increase yield. And if you start thinking about the time weight of money that, hey, listen, my checking is my 30 days and maybe my savings is, my next 30 days and I have my money market, maybe that's my next 30 days. And then as I keep flowing all my excess cash into my money market, I start buying more and more assets. And I got to tell you, I have had a lot of clients that I've told people that if you just keep saving with me and we start buying stocks that produce dividends, you're going to look back 10 years and be like, I cannot believe I'm worth that much money. And it's not that we did anything special. It's not that we bought any like super high-tech name that just skyrocketed and so forth. It's just simple investing. Because when you start investing in yourself and you buy assets that start investing in yourself and you start holding them, they grow a little bit usually over time. That's the statistics. That's why people invest, right? But then you have dividends coming in from those stocks. And hey, guess what? So you put $100,000 in an investment portfolio, and let's say that's paying an average of 3% yield. There's $3,000 going into that portfolio every year just from dividends. Well, let's say it went down 10 grand. Okay, that's too bad. But now you're buying stocks at a lower value that are producing income as well. Do you want to buy stocks high or do you want to buy them low? And so that's kind of where we move things back and forth, and we can buy the treasuries, we can get the T-bills inside your portfolio, those types of investments that are in between that might have a smaller yield period, maybe 0.75% more liquidity. But it's the idea, the concept of investing and creating return with as much cash as you possibly can, so that when you do mature and you're working with someone like us, and all of a sudden I got a lot of bonds. I don't think I need this much bonds. Believe me, we would have already had the conversation and already said, hey, listen, we're ready to move on to the next investment. We're ready to mature you into, hey, check out these stocks. Check out this investment portfolio. Let's get you diversified. Let's get you out of the cash conversation and get you moving at an amplified pace. Those are the kind of the things that I'm thinking.
Folks, it's been a great discussion today about cash and layering your investments and protecting your assets. You can reach us at 855-226-8551 or info@yourmoneyontap.com. I think one of the really great takeaways today, the brokerage account and being able for each entity have $2.5 million FDIC insured.
I have $2.5 million, not $250,000.
No, $2.5 million versus your bank right now offering you $250,000. That's incredible, and most people have no clue. And that's one of the benefits of giving us a call and talking through, what is your strategy right now with your cash, whether that's, whatever your entity is. It's an important conversation for you to have, and you can reach us at 855-226-8551 or info@yourmoneyontap.com.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.